House prices in parts of the UK are falling at their fastest pace in over a decade. And it's not just in small towns, but in some of the country's biggest, most talked about cities. Entire neighborhoods that were once red-hot property zones are now cooling so quickly that sellers are slashing prices just to stay in the game. Rising mortgage rates, sky-high energy bills, and the ongoing cost of living crisis are squeezing buyers out, leaving for sale signs standing longer than ever before. But here's the shocking part. This downturn isn't happening evenly. Some cities are holding steady, while others are quietly crashing beneath the surface. So, which 10 cities are leading this sudden decline, and why? Let's uncover the truth. Number 1. London. London, long considered the beating heart of the UK property market, is now showing clear cracks as the housing slowdown takes hold. The capital's luxury postcodes, once magnets for foreign investors and high-net-worth buyers, are among the hardest hit, with multi-million-pound homes seeing price cuts of hundreds of thousands just to attract interest. At the same time, commuter belt areas on the outskirts of London, such as Croydon, Bromley, and parts of Essex and Kent, are witnessing sharp declines as families struggle with soaring mortgage rates that have doubled or even tripled monthly repayments. This rising cost of borrowing has priced many first-time buyers and even seasoned homeowners out of the market, stalling demand and creating an oversupply of unsold properties. Interestingly, the picture is not uniform across the capital. While outer suburbs are cooling dramatically, certain inner prime zones like Kensington and Chelsea or Westminster are proving more resilient, with wealthier cash buyers less dependent on mortgages. However, even here, growth has slowed, and sellers who once expected bidding wars are facing longer wait times and lower offers. The divide is stark. For many Londoners, particularly in the middle-income bracket, buying a home in or around the capital has become an impossible dream, pushing them to rent or relocate entirely. Meanwhile, landlords are also under pressure, with rising interest rates eating into buy-to-let margins, forcing some to offload their properties at reduced prices. London, once untouchable in the property world, is now a prime example of how quickly the tide can turn when economic realities collide with overheated markets, leaving the city's housing future more uncertain than it has been in years. Number 2. Birmingham. Birmingham, often hailed as the UK's second city, and once a powerhouse for property investors, is now facing mounting pressure in its housing market. Over the past decade, the city attracted waves of buy-to-let landlords, drawn in by high rental yields, steady student demand, and ambitious regeneration projects that promised long-term growth. For a time, this strategy paid off. City center apartments were snapped up quickly, and rents climbed as young professionals and students flocked to Birmingham. But that boom has given way to new challenges. With dozens of construction projects completing at once, an oversupply of flats is starting to weigh heavily on prices. Entire blocks of newly built apartments stand with too many to let signs, making competition among landlords fierce and eroding profit margins. At the same time, rising mortgage rates are cutting into buy-to-let returns, leaving many investors unable to cover their costs. Some are being forced to sell, often at reduced prices, to exit a market that no longer delivers the easy gains it once promised. Beyond the city center, family homes in suburban areas like Edgbaston and Harborne remain more stable, but even their demand has cooled as borrowing costs rise and household budgets tighten. The once rosy image of Birmingham as a landlord's dream is fading, replaced with cautious buyers and nervous investors questioning whether the city has reached saturation point. With the supply-demand balance tipped unfavorably, Birmingham illustrates how quickly a thriving market can turn when enthusiasm and construction outpace realistic affordability, leaving both property values and investor confidence under pressure. Number 3. Manchester. Manchester, often celebrated as the UK's rising star for both students and tech professionals, is beginning to feel the chill of a housing market slowdown. For years, the city was seen as a magnet for young talent, boasting world-class universities and a booming digital sector that drew in thousands of renters and buyers alike. This strong demand encouraged a wave of new developments, with countless apartment towers reshaping the skyline and promising lucrative returns for investors. But that very boom has now tipped into oversupply. In the city center, especially around areas like Deansgate, Salford Quays, and Ancoats, the sheer number of nearly identical flats has left the market saturated, forcing sellers to drop prices and landlords to compete aggressively on rent. What once seemed like a safe bet has become a waiting game, with many units sitting empty longer than expected. Rising mortgage rates have only deepened the problem, eroding affordability for first-time buyers and squeezing landlords who relied on steady yields. While family homes in outer suburbs such as Didsbury and Chorlton remain relatively resilient, the heart of Manchester's property market, the student and professional rental bubble, has cooled significantly. Investors who rushed in at the peak are now finding themselves unable to secure the returns they once imagined, while new buyers are approaching with far more caution. This shift highlights a broader reality. Even in cities with strong reputations for growth and opportunity, property markets are not immune to the pressures of oversupply, high borrowing costs, and shifting economic conditions. Manchester's story is a reminder that rapid expansion can just as quickly lead to instability when fundamentals no longer match the hype. Number 4. Leeds. Leeds, often described as the commercial engine of Yorkshire, is now grappling with a property market slowdown that reflects the wider challenges facing UK households. For years, the city benefited from a strong mix of financial services, student demand, and a growing population that kept both buyers and investors active. But the recent surge in borrowing costs has hit families here particularly hard, stalling the momentum that once pushed house prices steadily upward. Mortgage rates climbing to levels not seen in over a decade have left many potential buyers unable to secure affordable repayments, leading them to pause their plans and wait for stability. This cautious approach has caused a noticeable dip in demand, leaving sellers frustrated as homes stay on the market longer and offers come in below asking price. In areas like Headingley and Burley, popular with students and young professionals, landlords are also reconsidering their positions as rental yields are squeezed by higher financing costs. Meanwhile, suburban family-friendly districts such as Roundhay and Orforth, once highly competitive, are now seeing fewer bidding wars as middle-income households rethink whether now is the right time to commit. Developers, too, are slowing their pace, wary of launching new projects into a market where buyer confidence is fragile. The slowdown in Leeds highlights how deeply mortgage affordability shapes regional property markets. Even a thriving city with strong employment opportunities and cultural appeal can see activity grind to a halt when financing becomes too expensive. For many Leeds residents, the dream of buying a home has shifted from an immediate goal to a long-term plan, hinging on when interest rates and economic uncertainty finally settle. Number 5. Liverpool. Liverpool, a city that has long leaned on ambitious regeneration projects and strong investor interest to fuel its housing growth, is now facing a significant downturn. For years, developers and overseas buyers poured money into the city, banking on its cultural appeal, growing student base, and government-backed regeneration schemes to deliver solid returns. This optimism led to a flood of new-build apartments across areas like the Baltic Triangle and waterfront districts, promising a modern lifestyle at relatively affordable prices. However, with investor appetite sharply dropping in recent months, many of these developments are struggling to maintain demand. Rising interest rates have cut deeply into buy-to-let profitability, leaving landlords reluctant to expand portfolios and, in many cases, looking to offload properties at reduced prices. The slowdown has been compounded by delays and setbacks in regeneration projects that were meant to transform parts of the city, eroding confidence among both buyers and investors who once saw Liverpool as a city on the rise. As a result, unsold stock is building up, and price reductions are becoming common across the market. For local families, affordability has always been a draw, but with economic uncertainty and household budgets under pressure, many are choosing to hold back rather than stretch themselves financially. This double hit, weak investor demand and hesitant local buyers, has left Liverpool's market particularly vulnerable compared to other northern cities. Once promoted as a hotspot for rapid growth, it now illustrates how fragile property markets can become when future expectations fail to match reality, leaving a surplus of homes chasing too few committed buyers. Number 6. Newcastle. Newcastle, often seen as the economic and cultural hub of the Northeast, is now witnessing a property market reversal after the sharp growth it experienced during 2021 and 2022. Back then, affordable prices compared to southern cities, combined with increased remote working, drove a surge of interest as buyers sought larger homes with more space. This mini-boom pushed values upward at an impressive pace, but the momentum has since collapsed. In 2023 and beyond, as interest rates climbed and living costs spiked, affordability quickly evaporated, and demand started to cool. Prices in several areas across the city, from Jesmond's student-heavy streets to family districts like Gosforth, are now slipping, reflecting this sudden change in buyer sentiment. What makes Newcastle's downturn more pronounced is the added layer of uncertainty in its local job market. With some large employers cutting back and fewer new roles being created, households are less confident about taking on long-term financial commitments like a mortgage. Even landlords, once reliant on a steady student and professional rental market, are feeling the pinch as yields are squeezed by higher borrowing costs and shifting tenant preferences. Developers who banked on sustained demand are also hesitating, slowing new projects to avoid adding more supply into an already cooling environment. While Newcastle remains a vibrant city with strong cultural and educational institutions, its housing market demonstrates how quickly local economic pressures can derail growth. After a period of rapid gains, the correction now unfolding is leaving both homeowners and investors cautious, and many are choosing to wait out the storm rather than risk buying or selling at the wrong time. Number 7. Sheffield. Sheffield, long regarded as one of the UK's more affordable major cities, is now feeling the weight of the housing market downturn in ways that are surprising both buyers and sellers. For years, its relatively low entry prices compared to cities like Manchester or Leeds made it particularly attractive for first-time buyers, young families, and even investors seeking steady rental returns. That affordability factor gave Sheffield steady momentum, keeping demand alive even when other cities slowed. However, the recent surge in mortgage interest rates has dramatically changed the equation. Buyers who once found Sheffield comfortably within reach are now being priced out, not because of the home values themselves, but because monthly repayments have become unaffordable. This has caused a noticeable pullback among first-time buyers, traditionally a crucial driver of Sheffield's market activity. Without their steady stream of demand, momentum has slowed sharply, leaving properties on the market for longer and sellers more willing to negotiate down. In popular districts such as Ecclesall and Crooksmoor, where students and professionals once kept demand buzzing, the rental market is also under strain, with landlords facing higher borrowing costs that eat away at yields. Investors who saw Sheffield as a safe bet are beginning to hesitate, while families in suburbs like Hillsborough and Woodseats are adopting a wait-and-see approach before committing to new mortgages. The city's housing scene, once buoyed by its reputation for affordability, now illustrates how quickly external economic pressures can erode even the strongest foundations. Sheffield remains an attractive place to live, but until interest rates ease, its market is likely to stay subdued, with cautious buyers holding back and sellers forced to adjust expectations. Number 8. Bristol. Bristol, a city often praised for its creative energy and thriving professional scene, is now facing one of the sharpest property cooldowns in the Southwest. For years, it was a magnet for young professionals, families, and investors alike, thanks to its strong job market, vibrant culture, and reputation as one of the UK's most desirable places to live. But that very popularity has driven the cost of living to levels many can no longer afford. With housing prices already stretched to the limit, the recent spike in mortgage rates has pushed affordability past breaking point, forcing many potential buyers to step back. In fact, some residents are now leaving Bristol altogether, opting for nearby towns or villages where homes and daily expenses are more manageable. This outflow has left the local housing market exposed, as demand weakens at the same time that supply is rising. Sellers, particularly in popular neighborhoods such as Clifton, Redland, and Southville, are finding that homes which once attracted bidding wars are now sitting unsold for months. To secure deals, many have resorted to slashing asking prices, often by significant amounts, just to entice cautious buyers back to the table. Landlords, too, are under mounting pressure. While rental demand remains, rising financing costs are squeezing profitability, prompting some to exit the market altogether. The result is a housing sector caught between high expectations and harsh economic realities. Bristol's story is striking because it shows how quickly a city's desirability can turn into a liability when prices outpace wages and borrowing costs rise. Once a poster child for growth and opportunity, it now faces a sobering period of correction, with both buyers and sellers adjusting to a far less forgiving market. Number 9. Nottingham. Nottingham, long known for its thriving student population and strong rental market, is now experiencing a sharp cooling in its housing sector. With 2 major universities and a steady influx of young tenants, the city became a hotspot for buy-to-let investors who relied on consistent demand to keep yields strong. For years, this dynamic created a competitive market, particularly in areas like Lenton and Beeston, where student housing dominated. However, the landscape has shifted dramatically as rising borrowing costs cut deep into landlord profits. Higher mortgage repayments have left many investors unable to balance the books, pushing a significant number to sell their properties. This sudden exit has flooded the market with supply, leaving more homes for sale than there are committed buyers. As a result, property prices are softening, especially in student-heavy zones where oversupply is most acute. At the same time, Renters are grappling with higher living costs, and some students are choosing shared housing in cheaper suburbs rather than paying premium rents closer to campus. For family buyers, areas like West Bridgeford and Mapperley remain attractive, but even there, uncertainty around interest rates is making households hesitant to move forward. Sellers who once expected quick offers are now finding themselves negotiating lower deals, with many properties sitting unsold far longer than in previous years. The decline in Nottingham highlights a broader vulnerability of cities heavily reliant on a single market segment, in this case, student housing. When investor confidence wanes and affordability shrinks, the entire ecosystem feels the impact. What was once a magnet for steady growth is now slowing, as both landlords and buyers retreat in the face of rising costs and shifting demand. Number 10. Cardiff. Cardiff, the capital of Wales and a city that has long benefited from its mix of culture, commerce, and connectivity, is now struggling with a noticeable decline in its housing market. For much of the past decade, affordability compared to cities across the border in England made Cardiff an attractive option for commuters and families alike. Strong transport links to Bristol and London, combined with a vibrant student population, kept demand high and prices climbing. But that trend has started to reverse. With mortgage rates surging and the overall cost of living rising, Cardiff's once appealing affordability advantage has eroded. Commuters who previously justified longer travel times in exchange for cheaper housing are now reconsidering, as rising household expenses and fuel costs eat into savings. The city's property market, especially in popular areas like Pontcanna, Roath, and Canton, is slowing noticeably, with sellers having to reduce expectations to secure deals. Meanwhile, new developments that were meant to expand the city's housing supply are adding further pressure, creating competition among sellers in a market where buyers are becoming increasingly cautious. Families and first-time buyers, traditionally the backbone of Cardiff's demand, are delaying purchases in hopes that interest rates or prices will ease. Even the rental sector, once buoyed by the city's large student base, is seeing cracks as landlords face higher borrowing costs and tighter margins. Cardiff's housing scene is now shifting from steady growth to a period of correction, reflecting the wider economic strains across the UK. What was once a city celebrated for offering better value is now showing the same vulnerabilities as pricier markets, proving that no region is fully insulated from the national housing slowdown. Broader analysis. What's really happening? Across all these cities, a clear pattern emerges. The housing market isn't just slowing in isolated pockets, it's being dragged down nationwide by the same powerful forces. Rising interest rates have dramatically increased the cost of borrowing, turning what once seemed like manageable mortgage repayments into financial strain that many households simply cannot absorb. At the same time, energy bills and everyday living costs remain elevated, squeezing budgets further and leaving less room for big financial commitments like home ownership. Sellers, who only a few years ago enjoyed multiple offers and rapid sales, are now facing longer waits and lower bids. But perhaps the most important factor is psychological: uncertainty. When buyers feel unsure about where the economy, inflation, or housing prices are headed, the natural reaction is to pause, watch, and wait. This hesitation feeds the cycle of slowdown, as reduced demand puts further pressure on sellers, creating an atmosphere of caution across the entire market. The result is a property landscape defined less by location-specific problems and more by a national environment where confidence is weakened, affordability has eroded, and the dream of home ownership feels more fragile than it has in years. Before you go, I'd love to hear your thoughts. Did any of these cities shock you, or do you see the same signs where you live? Drop your experiences in the comments. Your story might help someone else. And if you found this breakdown useful, check out my previous video for even deeper insights. We put a lot of effort into creating these for you. So please support us by subscribing. It's just one click, but it means the world.